On July 4th, President Trump signed the One Big Beautiful Bill Act into law, introducing sweeping changes in various parts of the tax code, including real estate. In this video, I'll go over what effect this legislation has on homeowners, rental property owners, and when these changes go into effect. Let's start with the good news for homeowners. The SALT cap, state and local tax deduction cap, is getting a boost. Starting in 2025, it increases to $40,000 for individuals and couples earning less than $500,000 a year. If you live in a high tax state, you probably felt the $10,000 cap from the 2017 tax reform, and not in a good way. Here in Jersey, property taxes for a middle class home can easily be over $10,000 a year. So this $40,000 deduction is much needed. But for some reason, this is going to phase down after 2025 and drop back to $10,000 in 2030. Next up, the mortgage interest deduction is sticking around for good. Homeowners can continue to deduct interest on the first $750,000 of mortgage debt. This was part of the Tax Cuts and Jobs Act, and now it's permanent. Plus, mortgage insurance premiums are deductible again. So if you've got PMI, you have some relief coming. Now let's talk about clean energy in homes, or more specifically, the lack of incentives for it. The Big Beautiful Bill ends two popular green energy credits. The Energy Efficient Home Improvement Credit and the Residential Clean Energy Credit are both ending after 2025. So if you were thinking about solar panels, energy efficient windows, or other upgrades, the end of 2025 is your deadline to still get a tax break. And now shifting to rental property owners. One of the biggest wins here is the return of full bonus depreciation. 100% write-offs are back through 2029 for qualifying rental property improvements. Think appliances, furniture, and certain improvements. This means real estate investors may be eligible to expense the full cost of those upgrades in year one instead of spreading it out over time. This also applies to accelerated depreciation components of your rentals, which could mean significantly reducing taxable income in the year that bonus depreciation is used. Now let's dive into one of the most under the radar but powerful parts of the bill: qualified opportunity zones. The bill makes qualified opportunity zones a permanent part of the tax code. No more sunset date. Gains invested into an opportunity zone fund after December 2026 now get a 5-year deferral. So if you sell a stock at a gain and use the money to invest in an opportunity zone, you could potentially defer the capital gains for 5 years. In addition, you would get a 10% step up in basis on that stock sale. Now let's look at an example, because I'm sure none of what I just said made sense. You buy $100,000 of stock, fast forward a few years, and the value of those shares is worth $200,000. You then sell them and invest into a qualified opportunity zone. You don't pay taxes on that gain in the year you sold the shares of stock. Instead, you pay taxes on that gain 5 years down the road. In addition, instead of saying that you paid $100,000 for the shares and sold them at $200,000, which is a $100,000 gain, you would be able to basically say you bought the shares at $110,000 and sold them at $200,000, which is only a $90,000 gain due to the 10% step up. This means you'd be paying taxes on a $90,000 gain instead of a $100,000 gain in this example. And if you invest in a qualified rural opportunity fund, you would get a 30% basis step up. So using the same example, you would only pay taxes on a $70,000 gain when in reality you made $100,000. And here's the kicker. If you hold an opportunity zone rental property for at least 10 years, you would owe zero tax on the appreciation of the property if you sold it. No 1031 exchange needed. On top of that, rural opportunity zones have another benefit to them, in that you're only required to improve the property by an additional 50% of your cost basis, not 100% like with the standard rule. Again, let's look at a simple example of this. You buy a property in a rural opportunity zone for $100,000. You would have to make only $50,000 of improvements to the property to qualify for the tax benefits of a rural opportunity zone. Contrast this with investing in just a regular opportunity zone where you buy a property for $100,000 and would have to make an additional $100,000 in improvements to the property to qualify for the benefits. That's a big win for smaller markets. And one more twist to opportunity zones. Every 10 years, governors must choose new zones. This means that it's not just a one-time shot. There will be new opportunities literally every decade. Another big change with the new bill for those with big portfolios that are bumping up against the estate tax exemption is that the big beautiful bill raises the estate tax exemption $15 million per individual. That's $30 million for married couples, and it's indexed for inflation starting in 2027. This means that your heirs could inherit up to $30 million in tax-free assets. Now let's talk about the timing of all of this. That bump in the SALT deduction cap, that kicks in for the 2025 tax year. If you're in a high tax state, you'll finally catch a break. The green energy tax credits, those wrap up at the end of 2025. So if you've been putting off that solar panel install, you've got a few more months to make it count. 100% bonus depreciation makes its big comeback on rentals put in service after January 19th, 2025. And as for the new opportunity zone designations, governors will start drawing those maps in July of 2026, and the new zones will officially go into effect on January 1st, 2027, and they'll last for a full decade. And finally, the higher estate tax exemption starts in 2026. So in summary, if you're a homeowner, there are tax planning opportunities on the horizon, especially in 2025. This includes getting any green energy improvements done this year, and you also have the increase in deductions for property taxes as well. If you're a real estate investor, bonus depreciation and opportunity zones should be on your radar now due to the great tax benefits, with most of these provisions going into effect in 2025 through 2027. All right, well, thanks for watching. If this helped you understand what's changing, go ahead and subscribe to the channel for more real estate financial planning content. I'll see you next time.